Hey everyone, if you own a construction company and you're thinking about selling it one day, this video alone can save you millions down the line. And I'm not even exaggerating when I say that. What I want to talk about today is what I call the mother of all tax strategies. Because when done right, and it's not something you can do overnight, but when implemented and executed correctly, you can sell your business up to $15 million tax-free, completely tax-free. And that's exactly what we're going to go over today. Now, what I'm talking about is called QSBS, Qualified Small Business Stock. It's Section 1202 of the Internal Revenue Code, and it's designed to give small, growing American businesses a nice tax break. Now, up until the OBBBA, which recently got passed, you could have excluded up to $10 million of gains. However, the OBBBA gave us now $15 million of a gain exclusion. And if you have a spouse that you can give like 50% of the shares to, you can do up to $30 million. Now, the four requirements for QSBS treatment are: number one, you must be a C corporation. Number two, the stock must be originally issued to you and or your spouse directly from the corporation. It can't be a stock transferred from somebody else. Number three, 80% or more of the assets in the business must be used actively in the business, which this should be a low-hanging fruit. And number four, at the time of issuance of the stock, you must have $50 million, you must have less than $50 million, of assets in the business. Now, virtually all my construction clients are S corporations, and truthfully, that is a tax efficient structure to become when you're a small business owner. However, there's times in the life cycle of a business where you want to graduate from just the S corporation structure, maybe have a management company that's a different entity structure. You can arrange things a certain way, but to keep it simple for purposes of this episode, you do need to become a C corporation for QSBS treatment. So if you do plan to have an exit in the next 3 to 5 years, it will be worth considering becoming a C corporation. You would have to make the election by March 15 of the given tax year in the year in which you want to qualify to become a C corporation. Once you become a C corporation, you'll have to issue yourself new stock from the C corporation, brand new stock. You can't use S corporation stock, a new class of shares, and those shares, once aged 5 years, will give you the possibility of QSBS treatment. Now, 5 years will give you 100% exclusion of the 15 of basically the sales price from capital gains tax. If there's also now with the OBBBA, there's also partial exclusions at 3 years and 4 years. There's 50% exclusion at 3 years, 75% at 4 years, and 100% at 5 years. Now let's walk through one very simple example together. Let's say you own a small, you're a construction business, and it is now today worth $10 million. To some people that seems like a far-fetched number, but I'm telling you right now, all you have to do is have EBITDA, take-home pay, at $1 to $2 million in order for it to be valued at $10 million. So $10 million is not a crazy number. As long as you're growing and scaling your business, a $10 million valuation is a very approachable number by almost any construction business owner. So let's just say your business is worth $10 million today, and you're tired, you want to take some time off, whatever it is you want to do, you want a nice payday. So you're thinking of selling your business a few years down the line. And now you want to strategize, you want to put yourself in the right position in order to do this. So let's say you're aiming to sell your business for $20 million in 5 years. So what happens then? If you didn't strategize in this way, if you just kept everything as is, as an S corporation, you kept slugging along and you sold the business for $20 million, you're going to get hit with 20% capital gains rate federal plus 3.8% net investment income tax. Now, if you properly set yourself up for QSBS treatment, you reissued the shares upon converting to C Corp, 50% to your spouse, 50% to yourself, you can now sell that $20 million company for zero federal income tax. Okay? Now, mind you, if you're in California, there you would still be taxed at the 13.3%. I have clients, and I've covered this in another episode. You should start structuring your business so that you're almost like a passive investor, you're a limited investor. And at that point, I would strongly recommend that you consider establishing residency in a zero income tax state, such as Nevada, Florida, Texas. Nevada tends to be, practically, commutable or somewhat close to California. So a lot of my clients do set up there. You have to spend at least 183 days. There's like 19 other criteria: your driver's license, residency, this and that. That's a whole other can of worms. However, it's possible to set your residency up in Nevada, sell that business for $20 million, and pay no federal income tax and no state income tax. And that's a lot of money. Now, to put it in perspective, bring this example full circle. What ends up happening is you sell your company for $20 million without this tax strategy at all. Completely living in California, not strategizing at all. You sell your company for $20 million. Federal tax, 23.8% between capital gains and net investment tax. That's about $4.8 million. Plus, California, $2.6 million. Let's do the quick math here. 2.6 million plus 4.7 million. That's about $7.4 million. You will be paying easily more than 1/3 of your gross proceeds in federal and state income tax. Now, if you were to follow my strategies, and it's not my strategies, but if you were to follow this strategy and elect QSBS treatment successfully, reconsider your state of residency, you can save $7.6 million, which is not little money. So there you have it. That is quite the strategy. So whether you're building skyscrapers, custom homes, commercial projects, whatever it is, you've worked too hard to give up millions of dollars to the government. So I strongly recommend talking to a CPA, a tax advisor, and a lawyer, getting the right mix of people in your circle and having this all set up correctly. So in 3 to 5 years or longer, however long it's going to be, when you do make this move, you end up saving yourself millions of dollars. I've had clients make exits and save millions of dollars and not pay anything to the government. But it required a lot of grit, a lot of strategizing, planning, and a lot of input on their part. So it's not something that you can do overnight. It definitely requires a lot of foresight and planning. So I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and I hope to see you in the next one.